go. All right, so I'm going to start the webinar. Right. Looks like people are starting to come in. I'll give it just a second. Let everybody trickle in. And then we'll get started. All right, let's go ahead and get going. So welcome everyone. We're doing our typical SEI update, economic and market update. We have our usual guests, Tim Gregory and Matt Potter. I'll introduce them in a second. Just a couple of quick housekeeping items. I know we've been doing this for a long time. Tim and Matt and I were just joking about how this is kind of the world we're living in now beforehand. So we're going to go through a quick presentation that Matt has, and then we're going to try and leave ample room for questions at the end of today's conversation. So as you have questions, feel free to go ahead and type them into the questions box. You should see that at the bottom of your Zoom screen. We'll hang on to those and let Matt get through his presentation, and we'll try and leave a good, 15, 30 minutes or so, depending on how long the presentation takes, to go through all the questions that you might have. And with that being said, one other thing, we are recording tonight. So if you want to revisit anything that we've discussed, we'll try and get that presentation posted in the coming days. And with that, I'll go ahead and introduce Tim and Matt. So Tim Gregory is the Business Development Director for SEI. Tim works with the largest advisors, helping them manage and develop their growth as a business. His team is responsible for practice management, consulting, and implementation of tailored investment solutions. Tim has been with SEI since 2008, a great year, I'm sure, to start at SEI. He is working previously within SEI's investment management service division, as well as the enterprise risk management. He holds a master's in finance from Penn State and also a Series 65. Tim is living in Newton Square, Pennsylvania, with his wife, Sydney, his daughter, Juliet, and son, Casey, who was born during the Eagles Super Bowl win. So I guess he's just slated to be an Eagles fan for the rest of his life at this point.
We're just glad we didn't name him Carson Wentz.
He's a Washington Commander now in our neck of the woods, so we've got him. We'll see how that goes. And then Matt Potter, who I'm sure everyone remembers from the past couple of times, past few years really, that we've been doing this. Matt is the Director of Investment Services at SEI. He's been with SEI since 2013. He's got 25 years of financial service industry experience. Prior to SEI, Matt was the head of client service for Lockwell Investments, a smaller boutique small cap investment firm. And then before that, he was a portfolio manager for Invesco, a portfolio specialist for Morgan Stanley Investment Management, and a performance analyst for Janney Montgomery and Scott. So he's got depths and depths of experience in this world. Matt is also a CFA charter holder, which is the gold standard in the investment world, and he holds a Bachelor of Arts from Haverford College and a Master of Psychology from the University of Pennsylvania. So without further ado, I guess I'll turn it over to you, Matt, and let you take it away.
Great. Thanks, Jared, and thanks everyone for joining us this evening. We're having a nice sunny day here in Philadelphia. I hope the weather is good there as well. And just one second while I set up the screen sharing. Okay, hopefully you're able to see the presentation. It has been pick your adjective for the year so far, and it's only April. So I thought, I'll dive right in. I thought what we would start with is maybe where were we? What were we thinking at the beginning of the year? So I wanted to revisit this slide. We like to show this where we look at a number of aspects of the economy, just in terms of what our expectations were for 2021, what they were for 2022, and then the check mark is kind of our own grade as to how close the reality matched our expectations last year. So you can see for the most part, and I won't go through every item here, but generally speaking, we were mostly favorable on 2021, turned out to be a fairly good year for capital markets. Coming into 2022, we expected maybe a little less economic growth, a little more inflation, tighter monetary policy, but again, mostly I think leaning towards the positive. I would say with what has been happening this year, inflation has come on maybe stronger than what we anticipated, partly driven by the invasion of Ukraine. And certainly I think that also has tilted economic growth more towards neutral. So by and large, I think the events that we've seen this year, and if you also throw in China's continued dealing with COVID-19, the latest variant, which has certainly impacted their ability to manufacture and ship out goods, that's just led to more backlogs, which also has fed into inflation. So by and large, I would say a number of our boxes probably would shift a little bit more to the left. The one thing where there's a bit of an exception would be the last one, investor sentiment, where generally you're going to want a little more pessimism, because if you have an extremely optimistic environment where everyone's bullish, everyone's fully invested, expectations are sky high, and it's much easier to disappoint when expectations are that high. More recently, we've seen investor sentiment come in. There was one poll, the American Association of Individual Investors, where they saw one measure of investor optimism was as low as it had been since 1992. So that, I would argue, is a good thing. When expectations can get reset, there's maybe a little bit more room to surprise on the upside, and even news that may be seen as neutral or less bad can actually be seen as good. So in terms of where we stand right now, a few key points. Clearly the Russian invasion of Ukraine has exacerbated some of the issues that were already developing when the year began and sometime before that. Whether it was shortages of goods and services, higher energy prices, higher prices of other commodities, including grains and other agricultural products, and some special metals. A number of these, again, really have fed into inflation, global inflation, as well as global energy costs. So as a result, central banks really have had to go completely into inflation fighting mode for the most part. Certainly within the US, we've seen a change in tone to really one, emphasizing raising rates, less, tighter monetary policy, higher, a number of other factors. And so the environment certainly has changed. And I think expectations for inflation, expectations for future rate hikes have also changed. They've changed quite a bit in a short period of time. That's had implications for both the stock market and bond markets. However, even with a number of negative events happening so far this year, first off, I will say almost everything we're trying to predict right now, there's a lot of uncertainty. You have to take it with a pretty big grain of salt. Things certainly can change, and there's a lot we don't know. How the situation with Ukraine will develop and come to a resolution, hopefully a peaceful one. We don't know when that will happen. We don't know how it will happen, what it will look like, what the implications might be for other countries in Europe, what it might be for allies of Russia. There's just a lot that we don't know. But with what we know now, our base case is that we don't go into a recession this year, and we may avoid a recession next year. We think that the concerns about economic growth certainly are valid, but balance sheets are still in good shape. There's still a lot of consumer demand, although the demand maybe is shifting a bit from goods to services. And corporate earnings, generally speaking, have still been fairly good, and profit margins still have been pretty compelling. So for the most part, even if growth slows, particularly within the US, we don't see an imminent period of recession. And so, for now, I would not necessarily characterize it as cautious optimism, but we think that some of the more dire predictions may be a bit off target. So let me go into what things looked like during the first quarter. I probably should have used red instead of green for most of these bars, because the first quarter was a period where most asset classes were in negative territory, whether you're talking about stocks, large, small, US, non-US, or whether you're talking about a variety of different types of bonds. Almost everything was negatively impacted because we saw growth fears, we saw inflation expectations increase, and we saw higher interest rates. All of those had a negative impact on both stocks and bonds. So a diversified portfolio, this quarter at least, there weren't too many places to hide. Normally when you have volatile markets, when you have volatility in stock markets, bonds can act like kind of a cushion and can help moderate some of that risk. But there are some periods where stocks and bonds are more correlated with one another, and both of them wound up in negative territory for this past quarter. There were a few bright spots, though. Inflation-linked bonds certainly held up better than most other types of fixed income instruments, and commodities were quite strong. Typically, and it will depend on the portfolio, but we are strong believers in diversification, and we often will include inflation-sensitive assets such as commodities within diversified portfolios. And during this past quarter, those portfolios that did have those assets certainly benefited from that type of exposure. Now, diving in a little bit more detail into the stock market for US large cap stocks, you can see energy was far and away the strongest performing sector for both the year in the light blue and the first quarter in the dark blue. And we've talked a bit in previous conversations about growth versus value, whereas growth companies, kind of the ones where earnings growth is expected to be faster than those of the economy as a whole or of their peers, versus value companies, those whose prices are lower, which tend to be more cyclical or economically sensitive areas, things like financials, energy, materials, that kind of thing. And there's been a bit of a deviation between those two styles. We have had a bit of a tilt towards value, and we do think that there are a number of reasons for liking value looking forward. But you can see the two really diverged quite a bit in the last part of last year. Starting around May of last year, growth, which is the dark blue lines, really went on a tear up until around year end, whereas value appreciated, but maybe not quite as much. Since the beginning of the year, though, growth really has come back down to earth pretty quickly. There are a number of big name firms. We heard negative earnings from another large firm today, which certainly have had an impact on a lot of the growth indices. And generally speaking, an environment where inflation is an issue, where rates are rising, typically is not a favorable one for growth. And we've seen that in terms of the weakest sectors being things like technology and companies related to technology, communication services, consumer discretionary, whereas some of your more value and some of your more defensive areas, things like utilities and consumer staples, held up a bit better. So this really was a quarter where you wanted to have either value exposure, particularly energy, or low volatility, more defensive exposure. But growth, which has worked for the past number of years, really decade or more, was starting to feel a little more pressure. And we think that can continue. When you look at the longer term of growth versus value in the US, what this line represents: when it's going down, growth is doing better. When it's going up, value is doing better. You can see, again, there's been a long streak of growth outperforming. But more recently, it has started to turn, and we think there is still more room for value to run. So In many of our strategies and many of our funds, we do have more of a tilt towards value. Not to say that we are just going all in on that part and giving up completely on growth. Again, we do think that diversification is very important, but when there are anomalies like this that present themselves in the markets, we like to lean towards areas that we think may be a little bit more compelling. Another area where we're seeing differences in valuations is when you compare US stocks to non-US stocks. Here, these are the valuations. How expensive are US companies in the dark blue versus companies of developed international economies in the light blue, or emerging economies, some of those less developed, less advanced, but sometimes faster growing economies, like you might see in emerging Asia or Africa or Latin America in the green. And you can see you are paying a premium to get US exposure relative to the rest of the world. And it's been that way for a little while, but it's not always the case. If you look back to 2010 or 2011, you can see that the US doesn't always trade at a premium, or at least such a dramatic premium as it's trading today. There has been, I think, a large favoring of US stocks over the last number of years, partly because the US has more technology and growth companies than other economies do. Partly also because I think the US has been seen as kind of an economic haven, maybe a little bit more sheltered and better growing than parts of the rest of the world. And certainly there's been a lot of negative headline news, whether you're looking at Russia and Ukraine, whether you're looking at China. There have been a lot of things to worry about. But again, just on a valuation basis, there may be some compelling opportunities outside the US. Again, we are big believers in diversification, and we would argue that while maybe because of the uncertainty, it might not be the time to overweight international, we also don't think it's necessarily the right time to give up on international entirely. There have been periods in the past where non-US stocks have done meaningfully better than US, and there likely will be periods like that in the future. We can't tell what the time frame is going to be, but our expectations are that performance, particularly within emerging markets and developed international, could wind up being favorable over the near and long term. Now, turning to bonds, again, it was a tough first quarter. We look at a variety of types of bonds over in the chart on the left. And you can see, again, inflation-linked floating rate notes. We're really, while they were down a lot less than other areas. But for the most part, again, a rising interest rate environment usually is going to be a major headwind for almost every type of bond that you can think of. And the rate environment really is characterized by the chart on the right. This is the yield curve. I've talked about it before, just as a brief explanation. So a bond really is just an IOU, whether it's from a government, a municipality, or a corporation. You're essentially lending, let's say, $10,000 to the US Treasury for a period of time. You get interest payments along the way. And then at the end of the period when the bond matures, you hopefully get your $10,000 back. Now, the longer you lend the money, typically the higher interest rate you'll get. If you're only going to lend your money for a month or 3 months, you're not going to get compensated as much as if you lend it for 10 years or 30 years. However, there are periods where that doesn't always apply. You can see a year ago, we had the yield curve, and this is for US Treasury bonds, looked fairly normal, fairly typical. Again, the further out the bond maturity was, the higher the interest rate. Well, we've also seen a large increase, again, driven by inflation expectations, driven by the Federal Reserve, who's started to hike interest rates and likely will be hiking them quite a bit more this year. And parts of the yield curve aren't showing that trend that you typically see. This is called an inversion of the yield curve. And you may have heard some of the talking heads on various cable news networks talk about this. when you look at inversion, the reason why it typically gets a lot of attention is in the past, it has been associated with recessions and has been seen as a good lead indicator. But you don't always get the full story. For one thing, the yield curve has to be inverted for a full quarter in order to quote unquote count as an indicator. It isn't really a genuine signal until it has been inverted for a period of time. And secondly, the parts of the yield curve, some people concentrate on what do 10-year yields look like versus 2-year yields. I would argue that if you want to go back to the original research, it was done by a professor at Duke University, Campbell Harvey. He looked at the 5-year rates versus the 3-month rate. And that part of the yield curve is not inverted and has not been this year. It may get there at some point. In fact, as the Fed keeps hiking interest rates, it may very well get there sometime later this year or next year, but we're not there yet. We think there are other types of metrics to look at. I'm not saying you should ignore the curve entirely, but don't take it as just because parts of the curve inverted for a few days, that doesn't necessarily mean that a recession is right around the corner. Speaking of bonds, again, it's been a tough period for bonds, and generally rising interest rate and inflationary environments can also be challenging for bonds. We think one of the best ways to deal with this type of uncertainty is to diversify. The more different types of bonds you own, generally speaking, when you have environments that are challenging, typically your gross return and also your risk-adjusted return will look better if you are more diversified. On the left side of the chart, for example, we're just looking at performance of U.S. Treasuries during past periods, whereas if you go more to the right, you're looking at more diversified portfolios, including things like high yield, bank loans, which the rates can adjust as inflation is higher, emerging market debt, Treasury inflation protected securities. So incorporating different types of bonds, again, can give you different exposures because not all bonds act the same in rising interest rate environments. You know, high yield, for example, formerly known as junk bonds, typically do fairly well in the early stages when the Fed is beginning to hike interest rates. So having some exposure there within your bond portfolio can certainly be a positive. We do think that being active and being diversified generally is the best way to approach bonds, and probably most asset classes, I would say. And I think this certainly does help to demonstrate that. But a rising interest rate environment doesn't necessarily mean that you're guaranteed to lose money if you're invested in bonds, because usually most of the return that you get from bonds is from the interest payments and not from changes in principal. And as rates get higher, there's an opportunity for reinvestment and for getting higher interest rates from your portfolio, depending on how actively it's managed or how it's structured. Now, let me jump to the next slide, where we kind of try to put it together and look at our assessment of sort of the good news and the bad news. And generally speaking, we do try to look at, you know, what may be likely to help the economy and markets and what could be an obstacle. Clearly this year, we have seen a number of obstacles present themselves. You know, Russia's invasion of Ukraine, again, at the top of the list, having implications particularly for Europe, but certainly globally, and making the inflation situation more challenging, and tying the hands to some extent of central banks, which now have to move away from supporting economic growth and labor markets to really fighting inflation. To some, it has reminded them of the period that we've seen in the 1970s, the stagflationary environment where inflation was higher than it typically is and economic growth was being challenged. That was a period where, you know, as people say, the music was great, the fashion more questionable. And that was a period where if you look at what did well, it was usually value stocks and to some extent commodities as well. So again, We're not saying that we think things are going to be exactly like they were in the 1970s. Let's hope not. But to the extent that we know what has done well previously in periods of inflation, that's good information to have. And again, I think that's one more piece that lies behind our preference for value stocks as we look forward. Now, the last slide that I want to show before we start to take questions, I've shown this slide a number of times, and I think it is a good reminder as to what normal stock market volatility looks like. Because it is easy to get concerned, and it may be tempting during more volatile periods like we've been seeing this year to wonder if stocks are just going to go straight down and if now might be the time to sell out and move to cash. So what this chart shows, and this data goes all back to 1928, even before the S&P 500 was known as the S&P 500, when it was the S&P 90 index. We looked at, and actually it was Ned Davis Research who did this, this study, looked at the number of times per year on average, and that's the blue bars, how often you would see markets decline 5%, 10%, 15%, or 20%. And you can see from this, drops of 5% from peak to trough, they're very common. They occur on average almost 3.5 times per year. Now, it doesn't mean every year you're going to see drops like that, but again, these do happen with a pretty high degree of regularity. And standard corrections, 10% or more, and we did experience that earlier this year. We had a peak to trough drop in the neighborhood of around 13%. Those happen typically once a year. So the kind of volatility that we have seen certainly is not unprecedented, and it is more normal than people might think. And we may actually be due for a period of somewhat higher than normal volatility this year as we look forward, just given the uncertainty, given the many factors that are at play. But that doesn't necessarily mean that you should try to time markets and sell out of them. That is something that really we have not found anyone who is able to do that with any degree of skill, any degree of regularity. And one of the reasons is, again, because markets are more volatile than people may think, there are a lot of false signals. Let's say, for example, markets have dropped 5%. And you get concerned and you think, well, they're probably going to go further. They may drop 10% or even more, so I'm going to get out. Well, the orange bar shows that only about 31% of the time does a 5% dip then become a 10% moderate correction. So more than 2/3 of the time, if you had sold after a 5% dip, you would not have gotten that 10% correction, and you would have been frustrated in your effort to time the market, and you would have had to figure out when to get back in. And similarly, a 10% decline, and while these aren't fun or enjoyable to go through, again, they do occur with some regularity, less than half of the time does that then become a 15% severe correction. So again, markets can give you many reasons to become concerned. And this is often why individuals who try to time markets wind up making bad decisions because we are all human beings. We are all emotional, especially when it comes to our money. And it's hard to be rational when markets are in what you think might potentially lead to free fall. And so people often will buy at the wrong time and sell at the wrong time. And typically that's not going to help your overall portfolio. So I think it is a good reminder. Again, we may see more volatility as this year goes, but there still are some positive aspects to the economy. Balance sheets, whether it's individuals, whether it's corporations, whether it's even states and municipalities, look to be in better shape, much better shape they were than, say, coming out of 2008, 2009. There still is a lot of demand for goods and also for services. As the economy opens up a little bit more, as people are more mobile, you're starting to see more travel. More people going to restaurants and concerts, sporting events, things of that nature. So there certainly is more economic activity that is occurring. So even with the negative headlines that we've seen this year, I think there still are reasons for at least some degree of optimism. And again, understanding that market volatility is normal, I think it hopefully gives confidence to stick with your plan, make sure you're in the right portfolio for your own goals and your own level of risk tolerance, but really not to try to time markets, but just to understand that while markets may give you sometimes a wild ride, over the long term, they have, at least in the past, rewarded you for staying invested. So with that, I know there are a number of slides that we'll need to turn to for our good friends in legal and compliance. I will zoom to those in a little while, but for now, I'm happy to take any questions. And Jared, maybe you want to moderate them if you've gotten questions from clients, or if you're seeing questions right now, certainly happy to address those.
Absolutely. I think one of the first places I'd like to go back to is you mentioning there's not a lot of evidence stacking up to see a recession in 2022 or maybe even 2023. I think the Wall Street Journal this week had a very good front page article on the history of Fed rate hikes and then leading to recessions. The historical evidence wasn't all that compelling for the optimistic crowd. I think only maybe 3 of the last 11 times they've raised rates, we've avoided a recession. So I was hoping just, maybe you could dig in a little bit more in what's behind some of the optimism on your side.
Sure, absolutely. And you're right in that usually when the Federal Reserve is raising rates, they are trying to slow the economy because inflation is becoming more of a problem. And, typically, the economy does go in cycles, and typically it is hard to achieve that so-called soft landing where you can slow the economy just enough to combat inflation, but not enough to push the economy into recession. However, when we look at, there are a number of different indicators you can look at besides the yield curve. There are various financial stress indices. There are other indices of how loose or tight monetary policy is. And generally speaking, right now, we aren't seeing a lot of those indicators in the danger zone yet. Again, not to say that they couldn't get there, and not to say that, we're going to avoid a recession forever. There probably is going to be an increasing probability of a recession, maybe second half of 23, maybe in 2024. Again, it's too early to tell from this point, but likely there will be one at some point on the horizon. Really, the question is just, when does this happen? And also, how severe would it be? I think the last couple of recessions we've had have been very severe. You look at the COVID-induced, while rapid, very deep recession of 2020, and also 2008, 2009, those aren't always typical of how severe a recession is. You can get more mild technical recessions, and a recession really just, 2 consecutive quarters of negative GDP growth doesn't necessarily mean that the whole system's going to fall apart, that, there's going to be mass unemployment or things like that. Economies can slow without, turning into as severe recessions as we've seen the last couple of times. So for us, I think it's more a question of timing. That again, we don't think that a recession is on the immediate horizon, but there are a lot of things that we do pay attention to. And again, when the Federal Reserve starts hiking rates, usually it's not the first or second rate hike that has a negative impact, say, on stocks or the economy. Generally, it's later ones. It's the 5th, 6th, 7th one that you really starts to kick in. And some of it also has to do with, what are the reasons why the Fed is hiking? Is it successfully combating inflation or not? There are other factors that are involved. So again, I think it is more complicated, more nuanced than just looking at, the yield curve has inverted and therefore we're headed straight for recession and therefore you should sell everything. Things are rarely that simple.
Well, I think, and to that point, looking back over the past couple of rate increases and decreases, we've seen the ability of the Fed to raise rates to a certain point become somewhat hampered. I think back in 2018, 2019, the market was almost laughing at the probability of the Fed raising it past 3%. So how much of maybe the increased balance sheet, the debt load of the country, how much of that is going to make it difficult for the Fed to raise the interest rates to where they would like to combat some of the inflation that we're seeing?
That is a really interesting question because, yeah, in many ways, our situation is different from what we've seen in the past, at least in degree. Whenever the Fed does raise rates, that is going to increase interest costs for maintaining our very large federal debt and deficit, and certainly that's not something that the Treasury wants to see. There may be conversations between Janet Yellen and Jay Powell about that and what kind of timing makes sense. There typically is a lag between when rates get hiked and when it starts to have an impact on the economy. I think, I don't envy the Federal Reserve right now. I think they are kind of trying to walk a tightrope, and we are in, to some degree, a very different situation than we've been before. The Fed's balance sheet has never been this large, or they've shrunk it a little bit, but it hasn't been as large as it recently has. And really, the extraordinary steps they took in 2008, they saw that by and large that they were effective, and therefore they amped them up even more in 2020. And the unwinding of that is the difficult part. So they certainly do face a challenging job, and I think there will likely be different factors in terms of how exactly to address that. That they're going to to look for, and certainly some of those could be political. I think the Fed does try to be an apolitical institution, but they are somewhat sensitive to public criticism. They are at least going to be hearing it. So again, I don't envy Jay Powell and the rest of the members of the Federal Open Market Committee.
Yeah, it's difficult position to be in for sure. I think going back to the slide of the different asset classes in the fixed income space that you showed earlier, we saw high yield doing very well. And of course, we know as interest rates are rising, that is going to hamper the performance of bonds. So why would we not A, go into something like high yield, or B, just get out of fixed income completely and sit in cash with the expectation that interest rates are going to continue to rise?
Well, again, it is really a form of market timing. And again, we do think that the more diversified you are when facing environments of rising rates, rising inflation, generally more diversification has helped, not less. High yield certainly can work at times during, again, the early stages of a rate hike cycle, but there then starts to be increased credit risk, and that can become problematic fairly quickly. And it really is, again, it is difficult to time not only when interest rates rise, but also, again, when does the impact of rising rates actually sort of take effect. So, high yield is a volatile asset class. It tends to act, kind of like fixed income, but also kind of like equities. And again, it is very sensitive to the overall credit environment. And I think what's also important to view is that, markets don't just price things on where we are right now. They are forward looking. They price things on where expectations are. We saw that last year where inflation expectations hit pretty quickly. I would say probably during the third, maybe fourth quarter of last year, and then they really ramped up. And when expectations hit, it's a lot harder to see when that's coming. You can look at measures like consumer price index or other metrics like that, but there still is an element of animal spirits. There still is an element of what do people believe, what are they expecting, what are they anticipating, and that usually is when you get the largest amount of change. So even if the economy still looks pretty good, and even if the credit environment still looks pretty good, if something happens that causes investors to become concerned about possible credit events sometime in the future, things can turn on a dime. And again, trying to time those events is extremely difficult, even for market professionals. And again, trying to do it, you're more than likely just going to hamper your own portfolio returns.
Yeah, we always
just to
like
add in there as well.
Go ahead,
yeah,
Tim.
go ahead.
Jared, just to chime in there, when you look at the alternative as well, being cash, we don't necessarily do performance calculations from a pricing parity standpoint on cash. And if we did, it looked very different. Because inflation last year was 6%. So just holding cash, you basically had a negative 6% rate of return on cash holdings in terms of how much goods and services you could buy going forward. And that inflation rate today is closer to 8%. So if we were doing the same sort of performance calculations on cash, your bond investments wouldn't look as ugly. And remember with bonds, if you think of them in terms of loans, right? When we buy a bond, we're the investor, but the entity issuing the bond, right, is issuing a loan. And I think most of us on this call either have a mortgage today or have had a mortgage at some point. Well, the banks that bought our loans and packaged them up and sold them to investors, right? Those are mortgage bonds. And when rates change today, those investors are seeing the value of those bonds go down. But the reality is my mortgage payment doesn't go down. Every single month, I'm still paying thousands of dollars to those investors. And so the cash flow is not necessarily tied to the performance. And so those losses are not locked in. As the cash flow payments are made, those kind of paper losses you see today will evaporate, and that lump sum payment will be due at the end. So as interest rates change, it's the market trying to adjust to put a price today on what the future value of all those cash flows are today. But the reality is if you have the patience to hang tight, a lot of that lost performance today will be recovered in the form of cash flows.
Yeah, great point. And we always like to tell clients, moving your assets to cash is probably the easiest of a two-part decision you'll have to make if you want to get out. The much more difficult decision point is when to get back in, right?
Right.
Look back to 2020, it was March 22nd was the bottom, and of course, nobody was feeling confident at that point. So it's a tough challenge to try and time the market like you're saying. Speaking of the market forces on interest rates, I think one of the most interesting things going on right now is as we look at the yield curve, the just exceptional rise that we've seen in rates from the Fed just alone talking about rising rates. They've only raised it from 0 to 0.2. They've only raised it 0.25% at this point. So one of the things I'm interested to see and get your opinion on is, as the Fed does raise rates, has the market already done a lot of the work, and could we expect similar increases to what we've seen? Or as we see the Fed raise interest rates, is the market saying, yeah, we've already priced this in, and we don't see the same kind of increases that we've seen thus far?
Yeah, very right. And yeah, I would, again, markets are forward looking, and bond traders aren't just kind of operating in a vacuum with no opinion about what the Fed's going to do for the rest of the year. So I think, again, when the expectations for what the Fed was going to do changed, they changed pretty dramatically. A year ago, I believe the consensus was the Fed was probably not going to raise rates at all this year. Now it's obviously much more than zero interest rates that markets are expecting. And so when you have that kind of a shift in sentiment and expectations, you can get a really big move. But again, the big move probably is assuming that, the next interest rate hike, say in early May, is going to be, 0.5%, and that there will be more hikes beyond that. So if we do start to get those kind of meeting expectations, that may not move markets nearly as much. We may have had, and again, it's hard to predict the future, obviously, but we did get, again, a very big move in a very short period of time. And, we may have gotten, most of the pain, knock on wood, from that very large move. Plus, we don't know what the pace of interest rates is going to look like. The Fed may wind up raising less than, what the market expects, or doing a little bit more slowly. We just don't know. So yes, I think you're right that a lot of what is already priced in is based, on what the Fed has said about what they are going to do or what they plan to do, and their kind of change in tone. Also, the fact that they're not just going to raise rates, they're also going to look to reduce the size of their balance sheet. And the question is that going to be done by actually selling securities outright, or are they just going to let them mature and roll off? And that still hasn't really, been resolved. So to some extent, the market has kind of done the Fed's work for it a little bit. If market activity can begin to, we're seeing higher mortgage rates right now, for example, we're seeing higher rates on credit cards. If that starts to lead to a, slowing economy, then again, the Fed has kind of gotten the effect of higher rates without actually having had to raise rates themselves. So sometimes, jawboning can happen. Again, sometimes markets are sort of trying to front run whatever officials are doing. But yeah, I would agree with you that if just because rates have risen this quickly doesn't mean you're going to get another similar type of move later this year as the Fed continues to raise rates, because again, markets don't operate in a vacuum. They're already assuming that there's going to be more hikes. And if the hikes happen according to plan, it may just be that that's meeting expectations as opposed to exceeding them.
Yeah. So we'll give it, this will be the last question just so we can wrap things up so people can get to their dinner plans. This comes from one of our clients, and if I can get my screen to work appropriately. So what might be the 1 to 3 most significant impact factors to watch to cause significant moves to the downside or upside?
Yeah, let's see. I would say, one of them certainly is related to corporate earnings. If you start to see, and every earnings season, and we're kind of at the beginning of it right now. In fact, SEI just reported earnings today. But as you see earnings reported, there will be some companies that do well. There will be some companies that miss expectations. But one thing that investors are looking for is guidance. How does the company expect to do for the rest of the year? If you start to hear a lot of companies saying, inflation is really bad, we think our demand is going to go down a lot, so we're adjusting our expectations for our sales and earnings down because we think the year is going to get worse. If you hear a lot of that kind of across the board, that may begin to lead to concerns about economic growth overall. Some of the issues that we've had have been more slow moving, like all the supply chain issues have been kind of building over time, and it's hard to necessarily see, is there one thing that could happen that could sort of tip things over the balance? But if China continues to be shut down, and if there is another, again, knocking on wood, this doesn't happen, if there is another wave of COVID, which is both highly transmissible and more lethal, because what we've been seeing the last couple of variants has been that they're more contagious, but also less lethal. And with more people vaccinated or more people having had exposure, there's more people with antibodies. The impact has tended to be less with each subsequent wave. But if we were to see another variant which changed that equation, I think that would cause a great deal of concern. Markets generally don't like negative surprises. And again, they certainly don't like uncertainty. That was a little bit of a contradiction, but they don't like uncertainty. If you were to see the Ukrainian situation, if Russia started to, make noise about possibly, going into another country or expanding what they're doing, again, I think there was just a missile test today, which probably was just Putin saber rattling. But if you saw, something that seemed like realistically, hey, we may start seriously using chemical weapons or nuclear weapons, then I think that would also raise some concerns. So those are a couple of things that I think could potentially happen. Very often in the past, though, what has really tripped up the market has sometimes been something that no one saw coming. Right. We go back 3 years, I couldn't have foreseen a pandemic, the likes of which have arisen. So often it's not the thing that you're looking for. It's something else that sort of just sneaks up.
Yeah, and I think that goes to your point, around uncertainty. The things that we're worried about now, we're already trying to formulate our risk reward, and the market's reacting daily to those things. It's always the thing that nobody foresees that really throws us for a loop. Any last words from you, Tim? What are you looking at right now?
Well, as we get closer to the summer, right, the political election season will heat up, and that's always a source of volatility. Like every election year, it's not necessarily a reason to redo your financial plan or have too much concern on what the markets will do to your investments, but it does create a lot of talk. It does create a lot of headlines. Volatility tends to follow that. The bright side is if you look back in history, right, typically these midterm elections are not very promising to the political party in power, so you could see a divided government, which history tells us actually is pretty positive for markets. Markets over time tend to do better during periods of divided government than unified government that we've had over the past year and a half.
Yeah, great. Yeah, that's that's also out there. It's an election year, a midterm election year, so that I'm sure we'll start to hear more and more about that as we move to the fall. So with that being said, thank you both. Excellent presentation, very informative. I know I certainly got a lot out of this, so I'm hoping our clients did as well. I'm sure we'll see you back here in the fall for another one of these updates. And again, thank you both very much.
Our pleasure.
Awesome.
Absolutely.
All right, everyone. I hope you have a great evening, and we'll talk to you soon. Bye-bye.
Take care, everyone.